What's going on, guys? Welcome to Stock Talk with Nico Kritikos. Today, we're going to do some stock analysis for Asml. This is a stock that is not available on some platforms like Robinhood. And I don't know if it's because it's an over-the-counter stock or if it's because it's a foreign stock or whatever the reason is. It is not on Robinhood. But today, I did buy a share of this just to get started a position on my Fidelity account. So it is available on certain platforms. Now, what ASML does is, if we read the description here, they engage in development, production, marketing, sales, upgrading, and servicing of advanced semiconductor equipment systems. It includes lithography, metrology, and inspection systems. Okay, so they are in the Netherlands. This is a $249 billion company, and we're going to find out if this is a good stock to buy or what the current status of this company is. So first thing we're going to look at is their revenue. The revenue is looking pretty good. We're looking at about anywhere from 16 to 18% over the last several years of revenue growth per year. Last year, they did $21 billion of revenue. As for net income, it's also looking pretty solid, pretty consistent. Anywhere, I would say around 24% a year is probably the more accurate number of growth they're averaging. And last year they did $6.4 billion. So $6.4 billion is a ton of net income for a company doing 20 something billion dollars in revenue. What are they doing? 21 billion. That's a really big profit margin. So we're seeing profit margins. These are net bottom line margins of 27%. That's really impressive. There's not many companies that do that. So both of those will get a check on my checklist. Then we go to the price to earnings, and we're looking at about 31 times forward earnings. So this is a $617 stock. And if we look at what analysts have them doing for this year, it's going to be $20, which is a huge jump up from 15. 15 to 20 is what is that? That's a 33% jump in EPS. So that's a impressive jump right there. And that puts us at about a forward PE of 31. If we look at where this company is normally trading, so this chart says, this chart puts it at a 31, and that's pretty much right in the median or the average. I would say if you drew a line in the middle of this chart, it'd probably be at about a 31. There's been a couple times when it goes all the way down to a 20. That's extremely rare. That has not happened since 2018. So, nearly 5 years ago. And for a while here now in this 2021 era, though, this was when things were mostly overvalued. So 40 to 50 times earnings is probably too rich for this company. But I would say somewhere around this 25 to 35 range is where it's should be trading, or where it's, you can expect it to trade. That's why I feel like it's not like it's an opportunity where it's like, oh my God, this stock's so cheap, I need to buy a bunch of shares. That's why I just bought one share today. It helps me just keep an eye on it and get an idea of, how the stock moves on a day-to-day basis. And in the past year, for almost a year now, it's been hovering around this $620 point. So I'm okay with buying one share here. I don't feel like I'm really overpaying. I wouldn't say I'm really underpaying. It's not a great value, but it's at least something to get started with because it's right around the average. So, if this stock dips down more, if it can get to 550 or 500, then I'll be interested in picking up some more shares. Then we're going to move on to innovation. Yes, absolutely innovative. And that's kind of going to lead us into this next one of market share, because the market share question is a little bit complicated. When I Googled this, I saw so many different numbers, anywhere from 7% market share all the way up to 90% market share. And I think that's the reason for that is because it's hard to categorize exactly what industry they're in and who exactly their competitors are. Because when you search up this company's competitors, I researched those companies, and they're not making exactly the same thing that this company is making. This company is making mainly the lithography machines that are used to create the chips. So in other words, they sell the machines to like Intel, and those companies use those machines to make the actual semiconductor chip. Now it says that one of these machines is about the size of a bus, and it costs up to $150 million, if not $200 million for one of these machines. I also read they're playing an important part in the new artificial intelligence chips that are going to be created. But the main thing I think that sets this company apart as far as a moat goes, and the reason you see 90% market share on some of these statistics, I think, is because if we look at this, we're going to see that they have something called the EUV, which stands for Extreme Ultraviolet Lithography Systems. So extreme ultraviolet lithography is used to pattern the finest details on the most advanced microchips, and because it packs more transistors into a single chip. The machine costs are about 150 million, but it looks like the point of this is that ASML is the only one that has this. I believe they're the only company that has this machine. The other companies have DUV, which DUV stands for deep ultraviolet. So it sounds like that's kind of the discrepancy here, is that these other companies may have the deep ultraviolet lithography systems, but ASML has the extreme ultraviolet one. That's kind of what sets them apart, and that's probably what puts them at the forefront, probably why so many companies like Intel would want to be one of their customers, and what's going to give them the edge to gaining a lot of market share. That's what it looks like from my perspective. Then if we move on to return on invested capital, we're looking at 35%. So their numbers for return on capital are also very strong. In the past, it's been, anywhere from 14% to 20%, but really these last couple of years, we're looking at 35 and 37%. So very strong numbers there. This one was a little bit disappointing, this next one. As far as equity goes, we are looking at, keep in mind, these balance sheets are in euros. Okay, this is in the European currency, which is almost the same as the American. It's almost 1-for-1 right now compared to the American dollar. The euro is 7% more. So it's a very slight increase, not a huge jump. But the disappointing thing here is that we go back, and for a company that has this solid revenue and net income growth, this strong moat, it's very high profit, extremely high profit margin and ROI numbers, you would think equity would be consistently growing, but it's not. 2019 and 2020, for a while, that was 2 years back to back, we're looking at over $13 billion of equity. Okay. Then it went down to 10, and then it slowly went back up to 11. And now we're back to 10. So it's not very consistent. And you would think we'd be, at least at 13 billion, if not 15 or 16. So that's not the end of the world. I mean, as long as it doesn't continue in that, if it happens for, 1, 2, maybe 3 years, it's not the end of the world. But if this keeps going down and this turns to a 9, an 8, and a 7, then that would be a bad sign. That would be that they're consistently decreasing equity. That's not good. It's not over 15% because it's only 10 billion, and this is over a $200 billion company, right? $250 billion company. So that'll get a no. Share count decrease, yes. Okay, this is nothing crazy here. This is just like a regular couple percent per year. Yeah, 1%, 1 or 2% per year it's decreasing. So that's, that's good. The assets are not 2x the liabilities. The profit margin is definitely over 10%, 30%, or at the top here it says 27%. Either one is super strong. The cash and receivables are not more than average annual income. We're looking at, let's go to the most recent one. We're looking at 12, 13. Well, actually, wait. No, this is over $12 billion. And in net income, they're doing $6 billion, right? Yeah. So, okay. So this gets a yes. I don't know why I put no. Their cash and receivables are strong, about double their last year's income. This company does have a dividend. It's very small. It's only 1.2%, so it's barely anything, but it is healthy. It's a payout ratio of only 22%. It's kind of consistent, not really. They have a couple of these where it's like for 5 years, they'll increase it year by year, and then it drops back down. So it's kind of, weird. I wouldn't say it's super. I mean, it's consistent. It's consistent that they've always paid one, and it's always been, it looks like at least $1 or so it's been. So yeah, but that's, I don't know, I would still count that healthy. It's over 10 years old. It was founded in 1994. And then is the free cash flow growing? Yes. If we look at this chart, you can see it's pretty similar to net income. Here's the regular free cash flow chart. So from 2013 to 20, the growth was slower. And then, of course, after the pandemic, we had this giant jump where the free cash flow nearly tripled. and then it came back down a little bit. Now here's the stock-based compensation adjusted free cash flow, which makes a minor difference, but probably actually helps the cash flow look better because they're decreasing their share count. So overall, free cash flow is $7 billion. That's good. That's strong. $6 billion of net income. That's strong. So I'm very interested. I mean, I think this is, you got to pay a little bit of attention to what type of valuation you're paying. Again, at 31 times forward earnings, not cheap, but not overly crazy expensive. So I'm okay with buying a little bit at this price. But the main thing, my main thesis on this is just, okay, the semiconductor industry is essential to the world, pretty much. The future of the world and technology is dependent on these semiconductor chips for the time being, right? For at least years and years down the road. And you can buy one of the dozens of semiconductor chip companies like Intel, Taiwan, Qualcomm, Skyworks Solutions, Cirrus Logic, all these different companies, right? Even NVIDIA, AMD, that's all great. Those all have opportunities in them too. But this company is more, I would say this company is even more unique, more special, because they're doing something that is vital to this industry that these other players like Intel are going to need. They need these machines, and they're really the only ones doing it. Or there's a couple other companies like Cadence Systems, I think, is one. There's a couple other companies that are kind of doing it, but either their products are maybe involved in the software of creating the chip, not this exact lithography system that this company has, or they have a lithography system, but it's this one. It's the deep ultraviolet lithography compared to the extreme ultraviolet. So deep ultraviolet processes carve electric circuits into semiconductor wafers with processes of 7 nanometers. Newer extreme ultraviolet lithography technology achieves even smaller processes of 2 nanometers and beyond. So that's what we're looking for. The smaller the number, because that means you can fit more on those chips, right? So yeah, a technology entirely unique to ASML uses light with a wavelength of 13.5 nanometers. This wavelength is more than 14 times shorter than the DUV, right? So it's pretty much like they have a monopoly. They kind of have a monopoly. That's why that's one of the main reasons I'm interested in this company, is just because they have that. They have a technology that's nearly a monopoly that these giant companies are dependent on, and that it is playing a vital role in a industry that is essential for the future, because every semiconductor chips are in everything. They're in all, laptops, phones, they're in cars, they're in some refrigerators, they're in like everything. So that's why they're so important. But that is my analysis for ASML. Thank you for watching, and I will see you in the next video.